Hello everybody, hello people, and welcome to Economica, all about economics. And welcome again for a new episode on this channel where I explain about all my messing around with economics and macroeconomic research and financial assets research, volatility, stocks, indices, ETFs, currencies, and all about economics, as I said. I do a lot of research about macroeconomic variables and interest rates and everything in between. So, as you can see, I'm sharing with you my on the screen. I have my Jupyter uh, environment, and today we are having a very interesting research about the tech sector and tech stocks, and I'll try to explain why we are in a big stock bubble, in a big tech bubble, technology bubble. And yeah, basically the point from where we're starting are the 100 stocks that are listed in the Nasdaq 100. And I downloaded the time series, so all the data of the stocks, which is open, high, low, and daily returns from 2008 up to Valentine's 2025, Valentine Day 2025. And then I downloaded also some other metrics, parameters of stocks, which are P/E ratio, the beta, the revenues, and the market cap, the average 3-month volume for each stock. So I have a lot of data that I worked through, and my Jupyter environment is something like 2,000 page PDF file, so it's huge. I will not be able to tell you everything in this video, and I honestly don't know which bits are the most interesting to you. So if you just type in a comment or leave a feedback, I can just come back to you with more data and more specifics. But the most interesting thing is that I basically studied each and every stock that is listed on the Nasdaq 100, and I can do that for anything that is in the stock market for regards equities. And so why I just said we are in a huge stock bubble. Okay, let's go to Excel. Very simple. And as you can see here, we have the name of the stocks from in alphabetical order. So these are all the stocks, all the 100 stocks that are in the Nasdaq 100, and we have the average 3 months volume, market cap, revenue, P ratio, beta, the ticker, and the stock price, and the the EPS, the earning per share. And from these data, we can easily derive what is the stock price with a 12 P ratio, so a normal P ratio, and what will be the stock price correction required to adjust the last Friday market price that we have for, I don't know, Alphabet, Airbnb, for all these stocks with a 12p ratio. Okay, so we can see Adobe, the the actual last Friday Adobe P ratio is 36.89. So we know there's a common jargon that the typical price to earning ratio has to be 12, 13, 14, just to have a normal, not so risky, not so bullish stock price. But here we see that all the Nasdaq 100 listed stocks, they have enormous, ginormous P ratios. AMD 111 P ratio, AIRM, I don't know, ARM, I don't know what it is, 221. I have to say I don't know all of these companies what they do. I have no idea, because I don't bet on the stock market. And please seek advice to your wealth manager if you have one. These videos, they don't are for investment advice, but these are in study or research which I explain the topic that I'm studying, and I bring you the data that I work with, and I show you the result of the data. So this is not investment advice at all, quite the opposite. What I'm trying to tell you with the data, I show you the data, I'm trying to tell you, don't invest in the stock market because it's very risky, and all the astronomical returns that you are promised, probably you won't have it, because you can give money to a wealth manager, but they will tell you, oh, you can't withdraw your money before 3 or 5 years, otherwise you want to be charged a fee, blah blah blah, this, that, and the other, and then you will never have your money back. So I'm not an expert. All I do, I study economics, I study finance, and I show you my work with data. So this is not investment advice at all. And so for this, I don't know all these companies what they do, but I have an idea for most of them. What I was telling you, let's say Amazon, we all know Amazon, it has a price to earning ratio of 40.47, and the price to earning ratio and the EPS of Amazon is $5.56, which is paid every 3 months. Then the dividend is paid every 3 months, and the price to earning ratio, the stock price was $228.68. Okay, so the price to earning ratio also tells you that if you buy one Amazon share and you spend $228, you will have to wait 40 years and 47 months to It's ginormous. You see, these are all really huge inflated stock prices with inflated price to earning ratios, and if and when investors or the stock market basically goes into mode of normalization of price to earning ratios, then each and every stock can fall down, can will have to reprice by way more than 50%. So I will never, ever, ever, ever hold anything of this. AMD, huge company, they have huge earnings, 20, 25 billion revenues, whatever the number, but the stock price will have to go down by almost 90% if you want a 12 price to earning ratio. Okay, and there is no way that the earnings per share and the revenues like AMD can grow its revenue by 90% from one year to another. Okay, so this is all a function of how market capitalization of these companies, they are inflated because there is way too much liquidity in the stock market, and this is all faults of central banks and of fiscal policy. So the Federal Reserve is responsible for this huge bubble, as the ECB and the Bank of England, the Bank of Japan, all all monetaries, they are all very much responsible for a huge stock market bubble, and economies like the real world of people who do have businesses which are in recession. Okay, so because all the money that is printed by central banks, they've all been uh, siphoned off into the stock market, and we have this huge inflated market capitalization: Alphabet 2 trillion, Apple 3.667 trillion dollar market cap, which is beyond any mathematical and financial comprehension. This is no way to evaluate stock. Okay, stock price. Apple, it's the price to earning ratio is 38.67. The stock price is $244, but the the real Apple stock price should be 75, $76 at, with the same revenue, but only applying a 12 PE ratio. You can apply a 14 PE ratio. Okay, let's do the experiment now, and Apple stock, instead of being $74, would be $88, but still the stock price will have to reprice by 63, 64%. So these valuation in stock market are truly, truly, truly exaggerated by a measure that is very, very dangerous. Yeah? It's here Marvel Technologies 100, the stock price will have to reprice by more than 100%. So this is really truly out of any um, P ratio is negative. So I don't know how this stuff is priced in the market. It's unbelievable. So MicroStrategy, it would have a negative stock price because probably they have a revenue of 463 million, 463.5 million, but the market cap it's 85 billion. So this is, I mean, I have no words for that. It's incredible. I mean, it's clear to see that this stuff is totally mispriced in markets, and when there's going to be a stock market, an equities or stock market correction, this is going to be huge. It's going to be huge, and lots of people, they're going to be left dry and empty on their pockets. So I don't believe at all these people, they have this huge stock portfolio and they are running and having fun with huge returns. They will end up with nothing in their retirement account. I'm totally sure of that. Just this market, it's very, very dangerous. And let's see, Tesla, $26. Yeah, it's unbelievable. 98 billion in revenue, but the market capitalization it's 1.14 trillion. So this is really beyond any rationale of mathematical or financial common sense to price stuff this way. Also, Meta platforms, it's unbelievable. I mean, stock price $736, and I'm just changing, not changing, but having the stock price normalized for a 12 price to earning ratio. Meta stock price is $295, okay, and still it would be very, so now $736. If you are a wealth management manager or an equity strategist and you are investing in this stuff, oh my good lord, my man, or my dear lady, you are in such a big trouble. If the market goes down, I don't want to be your client at all. And it doesn't matter to me if you have a Marriott put strategy our way, and you have an option strategy our way, and you have a barbell approach our way. If this stuff goes down, a lot of people are going to lose a lot of money. So definitely there is a huge stock market bubble, and I've been ranting about this for now a good 15 minutes. And yeah, so this Excel sheet is um, very easy. So you see all the P ratio, the price to earning ratio. If we normalize the price to earning ratio, then the stock, each and every stock that is listed on the Nasdaq 100 will have a stock price correction which is way larger than 50%. So not my cup of tea at all. And we can see this in also in a graphical chart. So when I coded on Jupyter, I coded for a bunch of portfolio allocation like beta portfolio, market cap weighted portfolio, equally weighted portfolio, risk parity portfolio, P ratio. So I took all the most common, most known measures, and I asked the machine to work out and pick and choose which are the stocks according to the Python code that would go into the portfolio allocation. So you can see here low portfolio. Let me squeeze in a bit, will be larger. Yeah, sorry. Okay, so for example, these are a portfolio which are based on the low price to earning ratio and high price to earning ratio, and machine allocates the weight 10%, 10 stocks, and these are the lower P ratio. These are the stocks except Baker Hughes, Kraft Heinz. I think these are canned beans or something like that, or mayonnaise. Diamonds by Comcast. I would never invest in Comcast, not even if I've been pushed on a on a cliff. Never, never, never. And these are IP ratio like CrowdStrike, which is, I don't know, cybersecurity, okay, but the price earning ratio is something out of this planet. Palantir and DoorDash, the delivery guy, 700 P ratio. Oh, this is incredible. And Tesla is in this IP portfolio ratio, so well done to Tesla for having this useless financial metrics which are really incomprehensible. And then the machine shows you the charts, the graphics, and then another example, low beta and high beta. Okay, so the beta is the slope of the volatility of a stock in proportion to the volatility of the market. And then we have low beta portfolios, low beta stocks, sorry. And these are the stocks that the machine has chosen, and like high beta stocks. And we see that we have AMD and Nvidia, which are very trendy stocks, but these have very high beta. So and Nvidia, AMD, I mean, if the market goes down 1%, the Nasdaq goes down 1%, then AMD goes down by 1.65, Nvidia 1.63, and Tesla goes down by 2.34, Palantir 2.8, and MicroStrategy, the marvelous company with the 400 million in revenue and 400 billion in market capitalization, will go down by 3 point. So these IB, the stocks, they are all, there are very trendy stocks that people here talking about every day. Oh dear. in the stock market, but these are not good investment. I mean, from my perspective, I would never put money on this stuff because are very risky. And yeah, so here we can compare. This portfolio are allocated according to price to earning ratio. This portfolio are allocated, are composed according to what is low beta and high beta. So we can see Kraft Heinz. Okay, there's a low beta and a low price to earning ratio, which is 12. So maybe this is a very safe stock to have. Kraft Heinz, nothing to worry about. It's just canned beans or mayonnaise. So then this portfolio is based on revenue growth. So what is the company revenue year on year? And so we have another Kraft Heinz again, and but for the revenue growth, then you'll have to study exactly. Well, you'll have to see more what is the balance sheet, what is the cash flow, and stuff like that. So the machine is very useful in working through the parameters and giving you an idea of how you would create a theoretical portfolio, although I will never invest in this stuff. But what I want to show you is that why we are in a stock market bubble, because here we see the projected portfolio growth over 5 years, and then there is the case for each and every type of portfolio. So the revenue growth portfolio, it's here and is the lowest one. It will be I think a little bit more than $1 million in growth over 5 years. But what are the portfolio that grow more, that have a higher portfolio return projected? So this is a machine simulation. Is the market capitalization portfolio, which is the blue line, which goes to up to 3 million in portfolio return. I think this is maybe for return after 5 years. This is a theoretical simulation, so by no means this is actually what's going to happen. But tendentially, market capitalization is what makes stock price grow and become larger and inflating the price, and so you see that you are gaining on your stocks holding. But the market cap, basically, it's not what is the real value of the business, what is in the balance sheet, what is in the cash flow. And that's why, if we go back on the Excel page, we see that the market cap is 200 billion, or let's take Micron Strategy, where it was, or yeah, Meta, like Facebook, and the market capitalization, it's 1.87 trillion dollars, and basically the revenue of Facebook, of Meta, it's only less than 10% of the market cap, 164 billion and a half. Okay, so the market capitalization tends to diverge a lot from what is the real value of the business, because then the revenue is the total figure, but then what is the net cash flow of a business is much less than 164 billion. And so the stock price tends to grow a lot with the market capitalization, because the larger is the stock price, the more uh, dumb people are betting on, are speculating on the stock price, and there is the next chicken marginal buyer that buys at a higher price, like a typical Ponzi scheme. Then the market capitalization grows and inflates, but the revenue of the business, they are always the same. So that's why this is a very dangerous way to play the stock market, because it's just you need the next marginal buyer for the stock price to go high. And see, DoorDash, it's a 80, 90 market cap, but the revenue is just 10 billion per year, so 10.7 billion. So the market capitalization is already, it's 9 times what is the actual revenue of the company. And with this Excel data, we don't know exactly if DoorDash is positive or negative net cash flow. So if actually the company earns money, because the EPS is 30 cents. So I will not be very sure that they are able to pay any sort of dividend, but a very minimal dividend. And the stock price is $200. Would you pay $213, $14 to have a dividend of 30 cents? This doesn't make any sense. The stock price doesn't make any sense at all. Doesn't make any economical sense. What is the risk of $200, and what they gave you is 30 cents every, I don't know, every 12 months? Oh, it doesn't make any sense. So that's why also Apple, it pays you $6 per year, and then you want to spend $240 for that. I will never do it. Never in my life. So Tesla, $355 for a share, but the dividend is $2.20 per year, and you're left to wait 158 years to have your money back. So it doesn't. And then what if the stock price stops going up? So you're gonna lose a lot of money. So it doesn't make sense. Nvidia, 3.4 trillion market capitalization, but the company generates revenues for 113.27 billion. So the market cap, it's, I don't know how many times over the revenue of the company, and the net cash flow still, it's an unknown. But I mean, these are totally uh, the stock prices for which these equities are trading, they are really wrong. And at some point the stock market will have a huge correction by 50, 60 or 70%, and I will not hold this stuff no way near this thing. So what I can do, I can show you some other, yes, you see simulated. So these are kind of simulation, like not sort of Monte Carlo simulation like method that the machine bot does. So here I asked the machine for a risk parity allocation, 10 million portfolio, 100 million portfolio. These are all the stocks now in this pie chart. It's difficult to see the ticker, but there are a lot of stocks which the machine allocates a minimal 2.5, 3.5% of a 10 million or 100 million fund. And the risk parity basically it's based on the volatility, the standard deviation, and then applying a weight to the standard deviation, so to have equal weighted volatility for each stock that goes into the portfolio. Well, these are the amounts, the theoretical amounts, and yeah. So these are the charts of for each stock. Adobe, for example, today, Friday stock price was $460. The stock price with, I repeat, with a 12 price to earning ratio would be, or theoretically at equal revenue, it's or equal earning per share, it's $150. Okay, so you can see here the big jump from what is the current stock price valuation, what would be the stock price with the 12 price to earning ratio. And this is Alphabet, 100 it's halved, $185. The real, the what would be the actual price is $97 with the 12 P ratio. Amazon from $208, it's a third. So the Amazon stock price valuation according to this method is one third of what is the actual stock market valuation now. So AMD is just 10% of what is the, and there are 100 charts. Let's go to Apple again, $76. Applied, see that is applied materials or something like that. It's 50% less. And see, yes, these are all bookings.com. So now the price is $5,000. The stock price of booking.com with the 12 price to earning ratio with equals earning per share, it's 1,777. So you can see the magnitude of the change from 5,000 to 1,700 or $1,800. So the stock prices are very, very much inflated, a lot. And Broadcom is basically worth nothing. And yes, I said there are 100 charts, and each and every one for each and every stock that it's listed on the Nasdaq 100, and all the charts they're all with the Z scaler. It's basically doesn't exist at all. So from in alphabetical order from A to Z, there are all the stocks, and Texas Instrument. 183 is the stock price, 12 P ratio is $63. So Tesla, the stock price would be $27. And it's unbelievable the bubble that's in the stock market. And I had some other simulation of allocating 10 million or 100 million portfolio, same with the risk parity strategy simulated. So these are again the stocks, the list of stocks, and with the bars, which is not a pie chart, so it's clearer to see the amount that the machine theoretically would allocate, and the risk parity, the weight for each stock, what is the volatility of each stock. Microsoft like 0.0178 standard deviation, and the machine would allocate 2.5% on a risk parity weighted portfolio. And yeah, these are basically by taking this list and seeing graphically what is the allocation for those stocks, and then you can theoretically with the code you can change the parameters, because as you can see here, the machine selects some parameters and it tells you the composite score is the parameter that comes out from the kurtosis, the skewness, and the standard deviation. Now, the kurtosis is basically the skewness to the fourth power or something like that. if I'm not wrong, or to the third power. And so one every time the kurtosis parameter is larger than 3, that means that the returns, the daily returns, the distribution of daily returns of that financial asset or the time series, it's not normally distributed first. But the larger is the kurtosis, the larger are the extreme events values. So the stock price could go up or down by a very large percentage in a day, and this can come with more or less frequency. So kurtosis parameter, if you don't want to have a very risky portfolio, it must be within 3. But all of these stocks, they have kurtosis 7, 12, 30. So these are very, skewness here also is huge. So these have all have very large fat tail um, events that are embedded in the historical prices of what is here. Microsoft, for example, has 9.1 kurtosis. So there are fat tails like Microsoft can have very volatile days and can go down by 3-5% or more, or can have a very large up day. Okay, so the kurtosis, that's what captures, okay, an extreme standard deviation. This also Google, they have Alphabet stock has a very large kurtosis, and these are other stocks I don't know exactly which company is that. And yeah, so with this code, for example, I can say I want a kurtosis threshold, it's 3. Okay, and then I can run the code, and the machine, if I yeah, it's working through the thing, it gives me the simulation of the portfolio growth. So we can see that the portfolio growth tends to be very, and then the allocation is just for 3 stocks. Okay, uh, DoorDash, which I will not, Crowd, and Airbnb, maybe it's Airbnb. So to have a larger basket of stocks, then you have to tolerate a higher kurtosis. Let's double the kurtosis, and which is not the cortisone way. And so you see that the simulation then runs with more stocks. It starts to include, there's a wider allocation to more assets, which are weighted differently according to their idiosyncratic parameters. So that's to say that financial assets, they are very, very volatile. So if I want to have a wider diversified portfolio, I will have to tolerate a kurtosis that is larger than 10. And here on this, yeah, see here, then you can see how the slope of the growth of the portfolio tends to change, because I'm adding risk, more and more risk of more and more larger extreme value, extreme returns in a day, which can be higher returns or very large losses in a day. And then the slope of the blue line, and then more and more stocks can go into the basket of the allocation, optimized stocks allocation. And here, yeah, I can vary also the other parameters. I can vary the weight, the kurtosis weight, the skewness, and standard deviation, and what is the threshold. So here, let's say I want the threshold of 5, and I'll even change the weight, and let's see what the machine tells me. Okay, you can see that the slope of the blue line, which are many simulations, I don't know how many simulations, 1,000 simulation for 252 days, it's 1 year, and it's 10 million on or 100 million fund simulation, and you see how then narrows down the allocation of stocks to. But DoorDash, don't invest in DoorDash, please, not even in Tesla and stuff like that. Texas Instruments, so it's all very risky stuff. But then if I say, okay, I want to take a lot of risk and a larger kurtosis, then we will have a larger number of stocks more stocks that are able to fit within the parameters and the optimized allocation of. You see that all these stocks, they have 7, 8, 9, 6, 4 kurtosis, so they have very large extreme values, fat tails, days that are within the historical data. So for since the IPO, all the days that the stocks have traded, some days they have displayed so large price changes, percentage changes, that it it push the kurtosis parameter well above 3, which is the safety parameter within between 0 and 3, let's say. But all all parameters above 3 for the kurtosis, they are all very risky. And yeah, so you can see the standard deviation of at least 1.5% daily, or 2%. So as I said, there is a lot to talk about, and yeah, I'm sharing with you my Jupyter environment and all the simulation that I had with the portfolios. And yes, so before doing the portfolio simulation, I did also a lot of volatility measure study. And yes, I had also a CAPM portfolio simulation. Oh, these are not relevant. Okay, so I asked the machine to tell me what if, for example, the dollar index um, as basically goes down by 20 or 30%, what happens to the stocks? And this is the scenario of 30% fall of the dollar index, 20% fall of the dollar index. So the green line is 30%, the red line is 20% dollar index down. And we can see here, for example, the behavior of Apple. So stock price will go to $200 or $180 in between the 20 and 30% repricing of the dollar index. So if the dollar goes down, it's not good for stocks. It depends on which stocks. For example, here A, B, and B. The simulation tells me that the stock price will likely increase in value. I find it very difficult, but most of the charts, they all display Adobe, so the stock price will fall to $400 or maybe $350, and ADP, also the stock price will go to $250, $240. So for all the scenarios, for all the stocks, when the dollar index starts to go down, then all the stocks tend to be repriced somewhat by also a 20-30% down. But as we saw here, according to the price to earning ratio, stock prices could go down well more than 50%. So these are all theoretical risk scenario for which I'm trying to tell you that stock market is very, very pricey and very, very risky. Let's pick Amazon, and if the dollar index goes down, scenario dollar index down 20-30%, then Amazon will price $200, sorry, or $180, $170, something like that. And yeah, yes, blah blah blah. So of course there are 100 charts for each and every stock that its price is listed on the Nasdaq 100. Let's see Cisco. Cisco will have a huge repricing to 50 or 40 bucks when the sun comes down. And yes, I'll stop singing. Okay, let's see here. Google, which is Alphabet, and yeah, it will reprice to 175 and 150 bucks. Yeah, you see how the machine simulates the repricing of the stock price as a derivative function of the dollar index going down and inflation going up, theoretically, unless there are other reasons. Let's see, Microsoft also will go nearly down to $300, so it's a large repricing as well. Netflix will go down to $800, though it's huge. Nvidia would price $120, more or less, which is not huge pricing, but I mean the chart is parabolic, so um, let's see. Qualcomm, small repricing, and yes, so all these charts, they all tell you how the stock price would behave according to a market risk event that basically sparks from the dollar. So as the dollar starts to reprice down, then you will probably see also stock prices following the dollars. Let's see, Tesla will just go down to $300 around there, $320. I mean, these are all simulations. Stock price of Tesla is already $330, so maybe there are some wrong data in this, but the notion is that volatility in the dollar will pull also stock prices down with the dollar. And as I said, I can show you. Wait, some other. I want to show you okay, let's go to the nitty-gritty of the EVT theory and pot threshold and stuff like that. So to identify when the market goes down and by how much the market goes down, we can calculate what are the VAR parameters and the expected shortfall parameter. So when I invest in a stock, I want to know how risky is the stock and how much risk I'm taking. Okay, so over threshold method with the Pareto distribution. Okay, and what it does basically takes all the historical data here, for example, of Apple, and this is the machine has implemented this method for all the 100 stocks that are in Nasdaq 100, and the machine tells me, okay, the VAR 95 of Apple is 2.1%, and the expected shortfall is 2.84%. I know that the shape of the epsilon parameter is positive and the scale of the sigma parameter also is positive. So this tells me that basically the historical data of the daily returns of Apple does have fat tails, or what I was saying before, extreme days of extreme loss, and these are basically are interpolated, statistically interpolated within the time series, applying these methods, and then the machine gives you these parameters and tells you, okay, there is a 5% probability that Apple can go down in one day by minus 2.1%, and the expected shortfall is 2.84%, and the shape parameter is 0.27, so it tells me that there are fat tails, or there is a larger kurtosis that we saw before, and it's larger than 3, it can be 7, 8, 10, 20, so there is probability that there are large losses in one day, large losses for the Apple stock, and you can assign probability to this one day large loss, and you can assign a probability also to the expected shortfall. That means that the stock goes down by 2.1%, but it can continue going down by the same amount as the same percentage at the expected shortfall. Okay, so these are more or less the parameters that I would like to have if and when I'm doing a theoretical stock portfolio allocation. I want to know what is the risk, how much risk I'm taking, what is the volatility, the annualized volatility, what are the VAR, the VAR parameters, if it's go, if it's offside, and then if it goes a lot offside, for example, we can see here the stocks are very volatile. So the VAR 99.9 for Apple is 10%. So Apple, in its whole history of trading in the stock market, there have been days when the Apple stock has gone down by 10% in one day. And then you can have additional expected shortfall of another 10.7%. So these are very large moves that can destroy savings of people, yeah, in a day, and you will never know when these things has struck, has hit your portfolio, and then you see the stock it's down 10% in a day. You say, what the heck is going on? And yeah, I mean, the average person doesn't do this stuff, and I can do it for you. Just drop a comment, leave me a like, send me a message, say, okay, please show me how much risk I'm carrying on my portfolio. If you have savings and you have portfolio, you don't need to show me your portfolio. Give me a list of stocks. I don't want to see anything, and I will tell you, okay, you're carrying this much risk, and then you'll decide what you want to do with your portfolio. I can just help you out for free, I don't mind. But I know that nobody will will send me this message, so that's why I'm so free speaking about this stuff. But anyway, these are the VAR parameters and the expected shortfall. And yeah, the charts basically as the curve, it's fits the excess return distribution, because you can have excess return in a stock and very large day of losses. So the VAR basically measures both sides of the argument, but it's utilized for extreme value theory and for a very large day of losses when the market goes down suddenly and you don't know why. So as we can see here, everybody says Apple is a huge stock, is a money machine, blah blah blah, but Apple has a lot of risk. So 5% probability, which is not a small probability, that the stock moves by 2.1% in one day. So the stock goes down 2% in one day, and you say, okay, but it can go down 5% or 10%, and so forth and so on. So these are huge risks that any investors has to account for. But we can see here Airbnb or Adobe to stay in the A of the alphabet soup, and all these epsilon parameters, they are all positive, so they tell me that there are fat tails. This one it's not so large because it's 0.06, but nevertheless it's positive. This one is larger for Adobe, but um, the VAR 99.9 still is 9%. The VAR 95 here, given that the epsilon parameter is smaller, the VAR 95 is just 1%, minus 1%, okay? So it's less than Apple, which is 2.1%. And you see the epsilon parameter, it's a larger number than this one, so that's why. The threshold, it's here, you see, peak over threshold. So we choose as a threshold, the machine picks the threshold as the VAR 95, and then you see all the parameters that go well above the threshold, and they have larger losses. So Adobe minus 10% in one day, and you have VAR 99.9. So yeah, and I have the data for all the 100 stocks, and let's go and see. I don't know. We are at the A, at the alphabet soup. Oh, I lost. I lost. I lost my savings in the stock market. Okay, so let's see. AMD is a very large epsilon parameter, and in fact, the VAR 95 it's 4%, minus 4%. So AMD can move a lot, and the VAR 99.9 it's 29%. It's really, this is 2029. In 4 years time we will have the centenary of the 1929-1930 crash, and I would not be very happy uh, by that time for sure. But anyway, I mean, the we never know, but the stock market can go down a lot. So I'm trying to scare you. So yeah, so you can see here that I have the data for all the 100 stocks, and yeah, with the parameter, and then yes, I did the same. You can do the same and work through the parameters together with a conditional volatility model, so that you can make the conditional volatility study of the historical returns of the time series. So you can have measures of what is the historical, the conditional volatility, like with this chart. You can see here, if we are in a period of very low conditional volatility, so you don't have to worry. And then what are the scaled var according to also the confidence level and the conditional volatility, and then you can have the parameters of the conditional volatility, the alpha and the beta parameter, in this case for the EGASH model, and then the machine also yeah, gives again the parameters here for Adobe. Yeah, and you can see here we can confront the parameters, and we can see here that these data are definitely not the same as by implementing only the extreme value theory without the GACH model, but the scale parameters, they are more or less they are identical, they are exactly the same as the charts that I showed you before. But this method is basically implemented and improved also with the conditional volatility model. So as I said, I have more than 2,000 pages of things with data, GACH models, and I want to show you just another method which is unknown to the vast majority of the public in the stock market, which is the jump method. Somebody says to you jump, and you say how high? No, no, it's not exactly that. It's not jump how high, are we? But we have in the stock portfolio, are we? Yes, indeed. Okay, what is that? Okay, so I will show you another couple of things which are related to extreme value theory, VAR, so value at risk, methods to measure what is the risk that a stock and the portfolio of stocks carries for any investors or wealth manager. So there is another method that is called the jump diffusion method. So what this method does basically, it works through all the historical data of daily returns of the stocks that you are watching carefully. What is Nvidia, AMD, Meta? Oh, I'm betting I have an option, a struggle and a saddle and what is that other? Ah, a butterfly strategy. Butterfly. I got butterflies. I got butterflies in my stomach. Right? So anyway, so the jump diffusion methods works through all the historical returns, and then it's able to see what, where, and when the stocks jumped the most in a day. So exactly like when everybody's sitting on their skis on the edge of the of the chairs, and you see that in the pre-market the stock or in after hours the stock jumps like 10%, 5%, then everybody, oh, I don't know why this stuff always happens on or pre-market or after hours, never during when the market is open to the public. No, there are some like dark pool dynamics which are not really transparent of a transparent stock market where full information or all information are available So the maximum efficient stock markets where all information are available to anybody and nobody can front run the market. But we see that the stocks they jump pre-market or after hours. So this is not maximum efficiency. And so I can explain how dark pools they are typical of Ponzi schemes, okay? Because there are a crook of like JP Morgan, Morgan Stanley, and other hedge funds. They work together, they pump the stock, and then they profit when even in pre-market or in after hours. And then all the people that trade the stock during the day, they bear the loss. And as I was saying, in pre-market opening, you see that the stock is down 10% and you basically have a margin call and you are wiped out. And then the broker takes the money from you. This happens because all the big investment banks, they don't operate, they operate in the open market, but to move huge amounts of trades, they utilize dark pools. And Bloomberg, for example, is the uh, archetype of a dark pool. So they put the order. Nobody knows who has dumped a billion or 500 million in I don't know, in Apple shares or in Tesla or Meta or all the Mag 7 or these very pricey stocks. And then all the normal investors which have no access to this information, to dark pools, they are left holding the stock that is down 10, 5, 10, 15, 20%. And this is contrary to the theory of market efficiency, because market efficiency tells you if market is strongly efficient, anybody in markets has access to all available information at the same time, and nobody has access to other privileged information even before other people. So I'm trying to explain why stock markets they are very dodgy place where a lot big players like big banks that they bet billions, of course they utilize methods to gain from the vast majority of the schmuck that throw their cents, their pennies or their dimes to the market. So the jump diffusion method tells you which are the days when the stock price jumps, how much it jumps, and by according to which parameters. So the jump diffusion method, going back to the meaning of these charts, simulated jump diffusion method path, so it utilizes in a more academic and polite manner a geometric Brownian motion, and which is basically a stochastic differential equation, which is based on the time parameter. So it's a random walk of a geometric Brownian motion, and basically this method, this volatility method, it gives you these very simple parameters. Okay, let's go for let's take the parameters that are for Adobe. If I have okay, these are here. Okay, so the mu parameter is the average expected return, expected continuous return of the stock. And so this one is 14% for Adobe, okay, on a theoretical 252 trading days in a day. The sigma parameter is the volatility. So the volatility, the 200 annualized volatility, as you can see here, for the jump, it's 35%. Okay, to be precise, is 34.93%. Then you see here the lambda jump parameter. So the lambda jump parameter gives you the intensity of the jump. So on the basis on the so just taking the number here, which is the parameter, you can see for how large is the data that comes out from the lambda parameter, then you can estimate the intensity of the jump of what? Of the stock price. Okay, and then for example, you can see here that 2.57 or 2.58, it tells me that Adobe stock price, theoretically, the stock price can jump 2.57 days for in 250 days, which are the trading days in a year. So for 252 days, which are the stock market is trading, in for 2.57 days, Adobe has the stock price of Adobe can jump of what? Of this mu, of this average of minus 9.3%. Okay, and the volatility of the jump is 3.13%. Very easy. This is very easy, but very useful, because for each stock that I want to study, I see Adobe, what is the continuous year-on-year return? 14%. The volatility of the stock, the sigma, is 35%. I know that in a day there are 250 days, 252 days of trading, 253 days of trading, and the lambda parameter tells me, okay, Adobe, you can have the stock price jumping up or down, in this case is down, for 2.5 days in a year, which is 1%. Okay, so 1% of the trading days, Adobe stock price jumps. And the stock price jumps, it's a negative jump. So you can have a pre-market opening of Adobe suddenly, which is 9% down. And you didn't know this stuff where it came from. And the vol in that day it's at least 3.1%. But if you have these parameters, then you know ex ante that the stock jumps twice in a year or three times in a year, and it jumps for a certain percentage. And this basically is the jump diffusion method, and jump how high, it depends from the historical returns of the stock that you are studying. Let's see Amazon, okay? And then you see the chart is very nice because it gives you the simulated jump diffusion price path. So according to how the stock price jumps, and what is the loss that you can have suddenly, then you see that the stock price, tendentially, the simulation brings down the stock price. Monte Carlo simulation, and nevertheless it's called Monte Carlo because the stock market it's a betting casino where everybody bets their pennies in the stock market, and the big banks they use the dark pools to harvest the money of the dumb investors. But don't forget, you must have a barbell approach. I don't find this the Bayesian, the Monte Carlo page. Where it is? So many pages. Gaussian distribution. I'm sorry if I'm messing around with this. I don't know if I can search. Dear. So many pages. These are the Garch model. Oh, it's taking so long. This. Yes, it's taking so long. It's taking so long. It's taking so long. I cannot find what I want to find, and I still haven't found what I'm looking for. And I still haven't found what I'm. Eccolo qua! I'm looking for. Here we are. Alright. Okay. So back to me. Okay. I'm not interested on what you were trying to sing. So back to me. Okay. So. What is it? What is it? Okay, let's go back. Start from A in the our alphabet soup, and we are at Apple stock. So what is this? It's a posterior mean distribution. So it's a probability Bayesian probability distribution of the mean return based on the historical returns of or historical daily returns of Apple, and based on a theta parameter that assumes a priori, so the prior mean basically assigns the theta parameters assigns a priori an expected value for an expected value of what is the average daily return of Apple stock, and then it works through the posterior mean distribution, and it runs 10,000 simulation with the Markov chain Monte Carlo simulation method, and it gives you this very nice chart, which is a, you see, standard normal distribution, which is skewed around 0, and it shows you what are the daily returns, +4 -4, maybe +6 -4. These are the density, not the density, but the frequency of the distribution on an horizontal axis chart. Yeah, and then gives you these parameters, gives you the trace. Okay, and yeah, okay, so this R parameter, this is R hat parameter. Hat is to say that it's R with a hyphen on top. So when it's 1, it tells you that the model, the simulation model fits perfectly the time series. So there are no parameters which are out of order. So when this parameter is good, then you know that the Monte Carlo simulation is okay, and then you can start to see um, these things and say, okay, what on earth this stuff means? So HDI is the high density interval. Okay, so on the lower bound, so the 3% and the 97% high density interval, you have the mu parameter, which is the average value, and the sigma, which is the volatility. So the mu parameters tells me that the average daily return is it's around 0% or 0.1%. So it's very symmetric to 0. Okay, while the range for the sigma tells me that it's around 0.01%. Okay, or 0.1% or 1%. I don't know. I'm very tired. This video is very long. So, but anyway, so this gives you the range for the sigma, the high density interval. So it goes through the simulation, it gives you the lower bound and the upper bound interval within which the average daily return and the average volatility it's estimated. So because this mu parameter, for example, it's okay, so these are the markup chain. So these are the parameters for Apple. Anyway, this is 0.1% mu, which is the average daily return of Apple stock. If I, because these are daily return, if I multiply for 252 trading days, then I can derive that the annual return of Apple stock simulated here is 25%. Okay, and this is the daily average range of the lower bound high density interval 3%, 97% confidence interval, and the range is between 0.014, 0.015, which is the sigma. Sigma is the volatility. Okay, and we have that all the parameters, all the simulation, the Monte Carlo simulation, they all have a R at here, which is 1, the mu and the sigma. So the Monte Carlo simulation works perfectly with the data. And so again, 100 simulation for 100 stocks, 10,000 simulation for a time horizon of 180 days, 6 months. And you see the full data range starts from 2008 to the end of 2025, including the 6 months simulation, but the data it's up to Valentine's Day or something like that. So this also works with the VAR days. So first of all, the simulation tells me, okay, Apple has a 0.1% daily return, which is a 25% yearly return, and the daily volatility is between 0.014 and 0.015, okay, which is a 1.5% daily vol, okay, and then the simulation, basically the Monte Carlo method, gives me the specific parameter for Apple for when every stocks as its bar day. Okay, so VAR tells me, okay, there is a 5% probability that Apple will go down by 2.2%, 2.1% in one day. Okay, so we saw before that the var 95 for Apple, it's minus 2.1%. Okay, what this Monte Carlo simulation method does, it assigns the probability that it's specific to Apple. So the probability that Apple has a var 95, it's 4.49%. Okay, so the specific probability of Apple, it's 4.49%. Okay, yeah. So what it means, in other words, is that the risk that carries the Apple stock, for example, is that here var 99, so 1% probability that Apple has a daily loss of minus 3%, and these parameters tells me basically that Apple has a 0.69% that the stock price will violate the var 99. Okay, and so is thus for all the stocks in the Nasdaq 100. So this Monte Carlo simulation method basically utilized a probability, a posterior mean probability distribution method to work through what is the probability that the stock has a var 95. Okay, so this means, for example, that just to make it clearer, if I can, that Apple has 4.49% days probability that it violates the VAR 95. In other words, that it goes down by minus 2.1%. So 4.49% of trading days in a 252 days in a year are the probability that Apple is gonna violate a VAR 95. Okay, it's gonna be offside basically. So this is another metric that works as the jump diffusion measure. So if I do 252 and oh dear, what is that? No, and I multiply for 0.0449, I know that, for example, for 12 days in a year, Apple can violate the VAR 95. And so for 12 days in a year, I have the risk that Apple will lose me 2.1% in one day. Okay, so this is what this very complicated probability distribution of the posterior mean probability distribution with the Markov chain Monte Carlo simulation method works through. It tells you basically what are the percentages of days in a 252 trading days in a year that the stock is going to violate what are its VAR parameters. It's going to be offside. 95% offside is going to be 99.9% offside, so forth and so on. And we can see, for example, that VAR 99 it's 0.12% of 252 days. Let's do it for algebra reasons. So, whoa, 30 days? Something is not clear to me. Yeah, because I put the wrong number in there. Yeah, it's 0.0012. Maybe it will be 3 days. Oh, yeah, for 0.3 days. So less than a day in a year, you can have a violation of VAR. You can be offside of a VAR 99.9%. And then I'm sorry I'm picking on Apple, but yeah, we have Adobe. We can go down and see AMD or Amazon. Amazon, it's 4.6% of days in a year, so we are still around 12 days in a year. Amazon can be offside for a VAR 95%, and then I can go and pick the data here. I can go and pick the data. Then I want to know Amazon, what is the VAR 95 of Amazon? Stay with me, bear with, 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 bear with. Okay, the VAR 95 is 2.5%, 2.55%. So, the Monte Carlo simulation method tells me that for 12 days in a trading year, Amazon can violate the VAR 95, and so the stock goes down by minus 2.55%. This is the beauty of the Monte Carlo Markov chain posterior mean probability distribution. And I think I can wrap it up with your posterior probability distribution. And yeah, call it a day for this great content that I've created. Yes, yeah, I have all the data that I need to work through the volatility. Yes, Google, it's 4.6% probability, so still it's 12 days a year. More or less they all have the same parameters, 12, 13, 14 days a year. see, Tesla, Starbucks, yeah, 4.6. They are more or less the same, yeah. So 0.12%. Tesla, yeah, okay, yeah, more or less. The simulation gives out more or less the same parameters for the probability of a VAR. Those days when there are extreme loss in the market. And then this is all for today. And I'll leave you with this thought on I like to love you and leave you. And these are the stock price in the last week. And these are the stock price with a normalized price to earning ratio. And be cool, be funny, have a lot of fun in your life. Just have a little fun and enjoy life. And please thumbs up, give me a like if you can, leave a comment. Thank you all for watching my videos, and see you to the next episode.